Hello, everyone. Welcome back to my channel. This is a new episode on financial literacy. And today I'm going to talk about demystifying multifamily rental investment. So, for new joiners, I'm Mukesh Goswami, your host and coach. I'm running a series on financial freedom through financial literacy. And do subscribe to my channel for continuous learning and unlocking the hidden gems on financial literacy program. So, what I'm going to cover today is 5 points. I'm going to start with a simple comparison of multifamily versus single family. Uh, the key differentiations in terms of the operations. I'll talk about some of the core concepts, the fundamentals of multifamily investing. I'll talk about why it makes sense to invest in a multifamily apartment complex. Then I'll talk about how you can get started as a passive investor. Is it easy? Is it difficult? Or the whole process to get into multifamily investing? And to conclude, I'll share what possible outcomes you can look as a passive investor from your investment in multifamily apartment complexes. So, before I jump in any further, few important disclaimers. As you may be aware by now, I'm not an investment advisor. I'm not a financially certified professional. This content is purely for sharing my opinion and my views. This is for the benefit of people to understand the financial concepts in a simple terminology. And as you all may be aware, investments do come with risk. Each investment involves a different degree of risk. You need to understand your own risk tolerance level and invest accordingly. Do read investment documents very carefully. Before you make any investment decisions, make sure that you understand each and every content in the documents. All right. So, with that disclaimer, let's jump right into it. So, let's understand the basic difference between a multifamily versus a single family. So, single family, uh, single family rental homes are any homes which are independent houses that either are one unit, a duplex, a triplex, or a fourplex. So, ideally, when there are four units, there are four families living in that, and in a literal sense, it doesn't mean single family, but from a real estate industry perspective, it is still considered a single family home, even though it contains two or three or four units. The moment you are five or more units, it becomes a multi-family home, and this becomes a commercial unit. So you have transitioned from a residential unit, which is 1 to 4 units, into a commercial unit, which is five plus units. So your financing for single family 1 to 4 units is considered residential financing, and it is based on your individual credit, your individual kind of borrowing capacity and everything related to that particular home. Whereas the commercial lending is lending to a business. So it is considered a business, and it has altogether different nuances of commercial lending. Rental yield. What is rental yield? The net rent that you can get from a uh, from an investment property is your rental yield. In a single family home, compared to a multifamily home, the rental yield is slightly lower. I'm not saying that rental yield is bad for a single family, it's still a very good lucrative yield. But comparatively, multifamily gives you a higher yield. And because of unit economics, financing cost for a multifamily complex is lower per unit than for a single family home. Similarly, maintenance cost, vacancy rate, they are lower for a multifamily compared to single family. So overall, these are the basic things that you need to keep in mind while differentiating multifamily versus single family. Many of you may have already invested in single family homes. So this is a quick differentiation for you to understand the other landscape. So let's talk about some fundamentals. What basically is the key concept behind multifamily investing? So from various analytic based reports and from various uh, organizations, it has been established that multifamily real estate investing is one of the best asset class for long-term wealth building. Good. So that's not something that I'm concluding. That's probably a lot of experts are concluding, and you can simply tap into that analysis at the face value. Now, in a multifamily investing, you are part of a business, and your business valuation depends on the net operating income. So your property's worth, your property's net value is linked to its net operating income. And what is net operating income? So uh, people who run the business understand that any income source is adding to your revenue, and any expenses that you incur to run that business is your kind of uh, uh, expense that you need to subtract from your revenue. So, to run a multifamily home, you need property management, you need to pay for utilities, you need to pay for landscaping, and so many other things. So, all those are your operating expenses that basically gets deducted from your uh, rents that you collect, the fee that you collect from your potential tenants, and all those kind of things. So that's your net operating income. And efficient management can increase NOI, and this increase NOI reflects in increase of the valuation of the property. To give you a perspective, a very minor increase in per unit monthly rent can cause a significant rise in overall property value. So just for an example, think of a 40-50 unit apartment complex with on an average monthly rent of $1,500. If you increase the rent by $50, which is 3% kind of rise, and it doesn't hurt individual renters if you are offering a good value, then that $50 per unit for 50 unit complex can give you approximately 10% increase in your net property value in a year. That's tangible, and that's how efficient management is the key to making your investment compound year on year. And in a multifamily investing, since so far you might have been exposed to only single family home investing, and you might have seen the residential lending. So in commercial lending, the the loans are based on net operating income and occupancy, and it's not, in most of the cases, it's not linked to your individual income or individual credit. So it's a whole new ball game of commercial lending, and it's a the lenders run a very thorough process of scrutinizing the every aspect of your net operating income. from that property. And that acts as a safeguard for you as an investor, that a team of professionals is analyzing each and every figure, each and every line item, and you can rest assured that they are doing a better job. So there are some flip sides to multifamily investing as well, and you should be prepared for that. So it's a largely illiquid kind of investment. So it's a longer term horizon. So do not expect that your multifamily investing can easily be liquidated in less than 2 years. So typically you need 2 to 7 years kind of time period to reap the right value. And the liquidation is not as simple as a single family home liquidation. It needs thorough planning and execution. And as a passive investor, oftentimes you do not control your own investments. You are investing into a pooled investor where the promoter, the sponsor, is managing the whole investment. So you lack that control, and probably sometimes it's good that you are not controlling, but other professionals, better equipped professionals, are controlling that investment for you. So again, in a single family home, on the exit, you can easily tap into 1031 exchange benefits, which is very difficult or which is harder to use in apartment complexes. I'm not saying that it's not doable, but it's generally harder. So bear in mind with these fundamentals, whether it's a game for you or not. With that, let's move into understanding why it makes sense. If these are the kind of so many points in favor or against, but why exactly it makes sense for me as an investor. So there are two broad points. Multifamily investing is mostly recession resistant. And why so? Because as the recession hits and it gets prolonged, people tend to downsize. People tend to uh, tap into their equity of homes by selling and downsizing the homes and moving into rental apartments. Living is still an essential need. So you need a place to live. So you downsize, you move into apartments, and you basically fuel the other economy. During recession, the rental fluctuation is intangible. There may be minor dent into it, but it generally is not significant. And because the rental fluctuation is intangible, the net operating income remains stable. And because your operations can get optimized in recession times further, so your NOI remains stable and hence the value remains stable. Overall, it has been seen and proven that for multifamily homes compared to single family homes, the declines in value is not sharp. Single family homes sharply decline and they sharply rebound after recession, but that's not the case with multifamily. And since it is an essential need, governments provide assistance to pay the rents. After food, the next big thing that government supports is your rent. So people may be undergoing hardships, but you as an investor eventually gets the rent because the government is supporting those hardships. So some of these factors contribute and make it a recession resistant industry. And that's a good thing to have as an investor. Second thing is when you set up a business, you need to really see that how long that business can sustain. So multifamily investing is a sustainable business because it has a sustained demand. And why so? From various trend analysis, it is concluded that Americans are preferring to rent rent is becoming the new buy. There may be so many factors. Renting offers you easy mobility, easy affordability in desired neighborhoods, and a probably lifestyle with amenities and services that you may not be able to manage on your own in a single family home. So I think people are getting a taste of the renting lifestyle. From various analysis, it is also evident that millennials are not buying homes at the same rate as the previous generations. So generations prior to millennials, they were basically more into buying single family homes, but millennials are not buying, rather than they are renting. And then we also see a big population of 75 million estimated baby boomers who potentially are downsizing because they are empty nesters, and they want to probably live in complexes with better amenities, convenient services, and a lifestyle that they can easily adapt to. So, all these factors easily give a long runway to multifamily investing. So, I think with these two big points being recession resistant and long term sustainable demand, it makes sense to invest in multifamily. Now, you may be making up your mind to invest in multifamily, but how do you do that? So, I'm going to talk about the pool investing, the syndication. So, it's very obvious that purchasing a multifamily complex need huge capital. It also needs multidimensional skills and a big resource pool. So it's not easy for individual people like you and me to go and buy. So what we do is commonly we pool in our funds and resources, and we all come together as a group of investors and use a mechanism called syndication. So syndication is just a legal way of pooling in your funds to buy into multifamily or many other asset class kind of as real estate. Now, the Securities and Exchange Commission, SEC, is the regulating body for these syndications. So there are rules and processes to be followed. Every the Securities Act of 1933 lays out those foundations that every new real estate offering has to be registered with SEC, and this acts as a protection for investors. In recent times, Jobs Act of 2012 created a boom for modern crowdfunding platforms. It enabled individual people to invest in real estates and such kind of asset class uh, with obviously some checks and balances, but it enabled, and that gave a big boom to crowdfunding platforms. So with technology and with the Jobs Act, pool investing syndication becomes easier. Now let's see how syndication works. So syndication, basically there are two key parties to syndicate. One is the sponsor, another is the investors. The sponsor, of often called a syndication team, is basically a an experienced entity that has some expertise in managing, acquiring, and uh, kind of building the network of investors and kind of carry through the sale. So the sponsor basically finds the asset that is right asset to be purchased. It offers that as an opportunity to investors to kind of participate in that purchase. And investors, typically passive investors, are individuals or entities like family trust or corporations or partnership firms and all. They basically purchase the share of that property by funding the overall capital need. So various amount of different individuals can participate by providing varying amount of capital. So eventually they get a share of the cash flow as well as the overall asset value. The complete job of a syndication team is to do the thorough analysis of a potential deal, evaluate it on different parameters, prepares the deal for people to understand that how it makes sense to purchase, then gets into the contract to buy, mobilize the funds through lending as well as through investor funds, and manage the whole process until the sale. So, in lieu of all this hard work, and this is a very specialized hard work that they do, they receive a share of cash flow and profits, and potentially a management fee as well. Now, once the sale is complete and the property is now an asset of the syndicate appoints a property management company to run the property on day-to-day basis, and an efficient property management company optimize the NOI, the net operating income. Their goal is to maximize NOI and thus increasing the year-on-year asset value. So though that NOI that keeps collecting eventually gets distributed to the passive investors as positive cash flow, and it is often distributed in a quarterly format, and sometimes it is also the preferred distribution. That means the investors get their share first before the management gets it. Okay, so this is in nutshell how the syndicate works. Let's quickly look at the syndicate organization chart. How typically a syndicate is organized. So there is always an investing entity. Let's say a LLC. This LLC is going to hold the title of the property that is being acquired. And this LLC is going to borrow the money from commercial lenders. Now, there are two class of members to this entity. Now, LLC have members. So there are two class of members. One is class A, which is investors, the passive investors. They own percentage of interest in this LLC. And the another class is the management, which is the sponsoring entity, which is basically doing all the hard work and putting in all the analysis and everything. So they also get a interest. So many syndicates have a 70-30, 80-20 kind of split between class A and class B. And then there is a management entity which basically runs the whole services, and they get paid as a fee from the investment entity. Now, the investors themselves could be individual people, could be entities. Management typically is an entity which has multiple members and derived from various expertise and all that. So this is how typically a syndicate is organized. Now, it looks kind of very organized, and there are so many avenues for passive investors to evaluate syndicates and then make investment through that syndicate. So as a passive investor, it's really not very difficult to get into multifamily investing game. So in the end, what is the outcome for a passive investors? So that's all what we are caring about, right? So the very first outcome is the cash flow. It's not really uncommon to see a double-digit annual return. While it is not really kind of guaranteed, but an efficient management can always ensure a double-digit, like 12%, 14%, 18% kind of annual return. That's common. There is a forced appreciation. If for a very professional and efficient management team can always keep on increasing the net operating income, and that forces the appreciation of the asset. That is a derived benefit, a longer term gain, right? As a passive investor, this is a truly passive income. A complete team of professionals manage your asset, and you simply relax and enjoy the benefits. It's inflation protection as protected as well. So it's a hard asset, and oftentimes in inflation, the real assets kind of appreciate, and it basically uh, kind of cop up with the inflation so that it doesn't get a negative impact of the inflation. Tax benefits, a big thing. Uh, in real estate, you get the depreciation benefit of your building and equipments, and that can easily offset your income. So the income that you're getting is a large portion of that could be tax exempted. And with multifamily investing, you get economies of scale. With your specific portion of the investment, you are tapping into a larger uh, scale asset, and that economies of scale give you better outcomes. So with that, I think it really makes sense for common people to look into this asset class and diversify their portfolio for the maximized benefit. With that, I think that's all for today that I'm going to talk about. Please do subscribe to my channel. Leave the comments and feedback in on the video. Suggest what else you would like to understand. I'll be very active in responding to your feedback and comments. That's all for today. Thank you. This is Mukesh Goswami, and I'll be coming back with another video soon. Thanks. That's all for today. Bye.